Hello and welcome to our market alert video for today, which is August 9, 2024. And I've entitled this particular video, "Is this the shudder before the next market crash?" And I'm hearkening back to the movie Titanic, and I'll get to that in just a moment. But first, hi. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America, and we're a firm that specializes in, I think, the most wonderful thing, which is the creation of SCWPS. And if you don't know what a SCWPS is the acronym for Second Childhood Without Parental Supervision. So when a client of ours retires, we call them a SCWPR, and we want them to go play and have fun and enjoy, and don't worry about all this boring financial stuff. Let us do it for you. And our website is RPOA.com. So, as you may recall in the movie Titanic, when the ship hit the iceberg, the hole in the hull was below water level. So there was a shudder. The whole ship shook. People woke up. They went out on deck. They looked down, and there was nothing to see. So they went back to bed. Don't worry about it. Everything's fine. Meanwhile, the billows underneath were filling with water. And eventually, as we all know, the ship sunk. And historically, as we look back, I remember in 2007, and the reason I remember that is because I was there. And that was a time when we had these big moves in the market like we've been seeing here in the last week or so, where you had these 2% swings in a day, up and then down and then up. And all these kind of moves are sometimes a precursor for something terrible coming. And so that's why I wanted to kind of use the Titanic allegory or vision for you to illustrate my point. Now, it may not be, but the point being, shouldn't you plan ahead if it is? Now, the two worst bear markets we've ever had, a bear market, of course, is when the stock market crashes big time, right? More than 20% is a bear market. But the two worst ones were the Great Depression and 2008 in our country. And in the Great Depression, the Dow went down 92%. Just think about that, 92% drop in the market. That's insane. People were jumping out of windows. They lost everything. And so fast forward to 2008, in that instance, the S&P 500 index, I call it the stock market, went down 57% from peak to trough. So 57% is a lot also. Now, the thing that is, many historians see the commonality between those two was a Fed mistake. Back in the Great Depression, the Federal Reserve raised interest rates into the Depression. Why? Because they thought, if we raise interest rates, then people will have higher income on their investments. They'll have more money to spend. Well, as we well know, that was a really bad idea because it caused the recession to turn into the Depression. 2008 was kind of the same sort of thing. The Federal Reserve lowered interest rates so much that what happened was that people were buying all these subprime mortgages with practically no interest to pay. And we created this massive real estate bubble, and the 2008 crash came after that. So the Fed, you could point the finger at them that they're the cause of the two worst bear markets we've had. And so now, today, there's a concern that they've raised interest rates faster than they ever have. It's breathtaking how quickly. And the economy is starting to, as we've chronicled in these videos, the economy was slowing down and the momentum of that slowdown is increasing. But what's really interesting, or depressing maybe, is if you look at what's happening in the jobs market. So in the jobs market, we're starting to see the bad news also, the momentum there start to accelerate. The only good news we had before this, which was keeping the market up, was, hey, yeah, the economy's slowing down, but the consumer still has their job, and they're 70% of the economy, and as long as the employment numbers stay good, we're in good shape. Well, those numbers have been showing up not so good, and that's why we've had these big moves in the market. So what does that mean? Could this be the shudder before the next market crash induced by the Federal Reserve? I don't know. It could be. My point here, though, is, does it not make sense to have a strategy to address it if it is? In our firm, we work with people who are over 50, who are retired or retiring soon. So for us, if you're within 5 years of your retirement or you're in the first 5 years of your retirement, we think it is very, very important to have a strategy to plan for that bear market, that big market crash. Because if you don't, we think that's just not very smart, to be honest. So hopefully we don't get it. I don't want that for anybody because people will suffer. But our strategy, Invest and Protect, did tell us to sell in November of 2007 before the stock market crash of 2008. Clients who followed our advice did not participate in all the stock market losses that happened in 2008. And that's significant, especially if you want to retire soon. You don't want to lose tons of money just before you retire. Could cause you not to be able to. You don't want to lose a ton after you've retired and now you have to go back to work if that's even possible. So that's why it's so important in our view. Growth is important, but protection of principal is even more important. That's our view. So if that resonates with you, we haven't hit our Invest and Protect strategy has not told us yet it's time to sell, but we're getting closer to that point. Now, of course, if you subscribe to this video, we will tell you what we have done, okay? In fairness to our clients, we tell them first, and then we'll tell you, okay? So there'll be a delay between the two. I love them more than you. What can I say? But if you become a client, I'll love you equally. So anyway, so go to our website. It's RPOA.com. Visit with one of our retirement planners. Perhaps we can make you a squipper as well. So right now, it's not a big bad bear market, but it could be. Plan for that. Have a strategy. The other side of the coin, just to finish this up, is bonds. And we think that bonds are going to do very, very well. We've been saying that all year. Once the Fed does start lowering interest rates, the longer-term bonds, longer maturity bonds, they have a multiplier effect practically. The bond aggregate index historically has gone up 10% for a 1% drop in interest rates by the Federal Reserve. So that's a significant leverage, and we think the Fed is going to lower interest rates at least 1% over the next 6 months. So there's a lot of opportunity there, which is the reverse coin of the stock market. So again, thank you for watching this video. I hope it finds you healthy, wealthy, and wise. And go to our website. Download. We also have a podcast that you can listen to, and we have tons of resources there for you. So again, thanks, and we'll talk soon.